Exciting conclusion on our series of Scott Single and whether he can retire at 60. 50-year-old man today. He's making $70,000 a year manufacturing widgets. He's putting $10,000 a year into his Roth 401k, and his company's matching 6% of his salary into the traditional side of his 401k. So he's got two things going on: Roth and traditional 401ks. He's want to retire at 60. He's got $200,000 in his 401k now, and we're talking about taking Social Security later on down the road. So that's the scenario. So can he retire? Yes, because he doesn't spend that much. He doesn't have a mortgage. Now, can he retire in the most tax efficient manner? That's what we're going to talk about here today and show you the exciting conclusion of my man Scott Single here. This is awesome. All right, so let's dive right in. Let me close out this. Oh, don't forget to subscribe, my friends. Lots more like this coming down the pike. All right, so let's go to the taxes. Remember, he's doing $15,000 a year, converting from his traditional 401k to his Roth when he hits 60 years old in order to retire. When he retires, excuse me. So when he's 60, all right, to 67, the only income he's got coming in, because he's got no earned income, he's got no planned distributions, required distributions. The only income he's got coming in is from his 401k. That's it. So look at that. He's got nothing coming in, and he still has taxes. He still needs about $55,000 a year for expenses and taxes. So the only thing he's got coming in is from his IRA or 401k. That's it. So we'll go over here and we'll show you. So here his 401k is grown to $423,000 by the time he hits 60. But he's going to start pulling money out of this pretty significantly because, one, he's taking $15,000 a year and converting to a Roth, but two, he's got to live, got to pay the bills. So let's see withdrawals from accounts. So here's his 401k. Whoa, he's starting to withdraw big amounts: $15,000 for the Roth and the $55,000 for his taxes and living expense. Draw big amounts and then nothing. When he hits 70, there's nothing to withdraw. And why is that? Why is there nothing to withdraw when he's 70, Josh? Well, let's take a look. Why is there nothing to withdraw when he's 70? Oh, because he's got no balance in the account, which is exactly what we want. When he's 70 years old, the only thing he's got is his Roth 401k and his traditional, or I should say his Roth 401k. Roth 401k and Roth IRA is the only thing he has when he's 70 years old. So let's just take a look at the taxes, shall we? I love it. Watch this. Oh, my goodness. He hit 68, 70 years old. He's got no taxes. None. No taxes for the rest of his life. For the rest of his life. No taxes. That is like a cliff off the the Irish coast or something like that, or Acadia National Park in Bangor, Maine, not Bangor, Bar Harbor, Maine. We say Bahaba. Now the only taxes he has to pay is when he's still working. All right, he's going to lose 25 to almost 30% because of FICA and because of state tax and then federal tax as well. So, and here he's losing 25%, 25%, 25%. Then up here he loses about 28% or so. Then we don't have FICA anymore, so we lose about 17%, 17%, and then kaboom! This is when Social Security kicks in. He's losing 12%, 13%. Kaboom! Social Security is still 67 is when Social Security kicks in, 12, 13%. And then right here, kaboom, nothing. When he's 70 years old, nothing. So he must be living in squalor, right? Like our man Jonathan Clements said when my man Ty Bernicki wrote the original article on reality retirement spending in 2005 in the Journal for Financial Planning, which I do not have. Oh, right here. This isn't the copy of it, but this is what the Journal for Financial Planning looks like. And Bernicki wrote an article in February 2005 that talked about reality retirement planning or spending, which really broke the mold on the traditional way of looking at things. Said, no, that's not the way to look at it necessarily. And Jonathan Clements, because Bernicki said people don't spend as much. That's just all there is to it. As they age, they spend less, considerably less. And Clements says because they run out of money. And look, they don't have any taxes, thus they must have run out of money, right? Well, let's take a look. So we're going to go over here to retirement. We're going to go to accounts because remember, if you don't pay taxes, that means you ran out of money, right? Let's take a gander. Shall we? Shall we take a gander? And let's look at accounts. Shall we? Oh, man, I just love this. So he's 70 years old. He pays no taxes. But wait a second, Josh. 70 years old, he's got 258. He got 500,000 bucks in his Roth 401k and Roth IRA. Oh, at 70, he's got 538,000. Wait a second. At 72, he's got 600,000, but he's not paying any taxes. How could that possibly be? That doesn't make any sense, Josh. And then he starts at, he does have RMDs, so the RMDs start kicking in. And on top of that, he's starting to spend less than he's coming in, even though we had him spending about $3,000 a month or $2,750. It doesn't even matter at this stage. So the more he's taken out because of RMDs, because he does have RMDs on a Roth 401k, which means we just want to move that over to a Roth. It's a tax-free event. That way, a Roth IRA has no RMDs, but I forgot to do that, so it's no big deal because it's all not taxable. Here is actually going to create a little bit more tax, you would think, because it's going to have capital gains and dividends, but I'll show you why that's not even an issue right at that point either. So he's got Roth 401k, he's got Roth IRA, he's not paying any taxes, and he's going to die with $2.2 million when he's 95 years old. It's a wonderful thing. So let's look, my friends. Let me just go back. Let's just go back to taxes, shall we? This is just federal, state, and remember, he's in Massachusetts, my friends. Oh, nothing. Now the federal is paying $10,000. Let's see. When he was 80 years old before, he was paying $12,506. When he was 80, nothing. When he was 65, he was paying $8,307. Let's see. When he was 65, he was paying $8,307. Here he's paying he's paying $14,739. So he's paying more on the front end. When he was 85 years old, he was paying $19,630, and now he's paying nothing. And so you can see what happens by just doing this strategy right here. He is paying a little bit more in front. There's no getting around the taxes. That's all there is to it. No getting around the taxes. So before he was doing $16,809 in taxes when he's 55. Now he's doing $19,886. So essentially $3,000 more. At 60, he was doing $7,340. Now he's doing $12,230, essentially $5,000 more. At 76, that is. At 70, he was doing $3,283. Now he's got nothing. He's got nothing. So you can see you're going to pay a little bit more on the front end, probably $20,000 worth, or I'd say about $20,000, maybe a little bit more. But you're not paying anything on the back. In fact, immediately right now you're going to save. From just not when you're 85 years old alone, you're not going to pay $19,630 like you were doing previously. When I say previously, when he was doing the traditional 401k and not maximum, and then and simply putting in his own deferrals into the 401k and not doing any Roth conversions. Now he's got $19,630 in taxes when he hits 85, and now he's got nothing. Or he did back then. Now he's got nothing. So let's look at a tax form here. So let's go back, and I already showed you the 1040 for 2039 this year, 1040. So let's look though. We'll look at the taxes and when he's 65 years old. So that'll be, oh man, I always do that. Hold on a second. I can't remember what year that would be. When he's 65 years old, cash flow. So I got to write that down so I can remember this next time. Oops, just dropped my pen. 65, 2033. Okay, 2033. All right, so when he's 65 years old, let's see what the taxes look like then. All right, there we go. I dropped my pen, excuse me. And we're going to go to details. And remember, before he was paying $8,307, and now he's going to pay $233. Now remember, he hasn't started taking Social Security yet either. He's got no wages. He only has IRA distributions of $83,000, but it's basically $84,000, and that becomes $15,000 from his IRA, from his 401k, and on top of that, whatever he needs to live on. So that's the only wages he has comes from his IRA or his 401k. You take out your standard deductions and your personal exemption. Your taxable income is $67,000, which means you're paying a Fed tax of $10,626. All right. And then you're paying whatever to the state. I can't remember what it was off the top of my head, but if you're told $10,626, yeah. And so we go back to retirement, and we'll see what the state was. $10,626 to feds, and the state will be taxes. And again, this is Massachusetts, which has, I think, the 5% flat tax. And the state at 65 is $4,113. Okay. Now let's fast forward to 2000, and that's 38. So that was 2033, 2038. He'll be 70 years old. He's taking distributions. He's taking Social Security at this time. Man, just, I love the tax code. Thank you, Congress, for making it so doggone complex that someone like me can actually find enjoyment. Wow, look at that. Do you see what I see over here, my friends? A whole bunch of zeros. But so he must not have any money, right? Oh, he does. He's got 45,733 of Social Security. But that's Social Security Part 20A. But let's go over to Social Security Part 20B. He's got no taxable amount. Why is that? Anyone want to guesstimate why? Because he has no taxable income. And if you have no taxable income, you have no taxes due. Now, my initial thought process was there any way to take advantage of the standard deduction here and the personal exemptions to maybe reduce some of the taxes on the front end to take advantage on the back end? But you really can't do that because the way Social Security is. So for every dollar you get of standard deduction, if you add that extra dollar to your taxable income, is actually going to be raise your taxable income not by $1, by almost $2. And so it's just hard to manipulate that for sure. And if you don't know what I'm talking about, just look at my videos on how $1 of taxable income or $1 of more of income actually increases your taxable income by $1.85 once you are in Social Security. So here I messed around with that. It's hard to figure out how to do that specifically. I'm sure there's a way, but it's just not worth taking the time to do that because this is such a beautiful thing. He's paying no taxes, none whatsoever, none. All right, so let's keep going. That's 2038. Let's go to 2048. Now he's going to be, what's that, 80 years, something like that, 80 years old, I guess. Yeah. He's got $5 in taxable interest, $9 in ordinary dividends, and he only has taxable Social Security of $2,138. Remember that? We do the provisional income, but watch, his taxable income is still zero. So he has taxable Social Security of $2,152 because we do the provisional income, right? So that's a fact. A little bit of his Social Security will be subject to taxation, but then it won't be taxable because his standard deduction and his personal exemption are much more than 2,152 of his Social Security income. That's taxable, so he still pays nothing. Let's fast forward to 2058. Again, more beauty, and here we're gonna have more capital gains and dividends. And we got 346 of taxable interest. We got 328 of capital gains and 635 of ordinary and qualified dividends. And now we got a whole lot more taxable Social Security, 8,000. So our total income, this is our total income that the IRS sees, not our total income, because we got 75,000 Social Security benefits, but our total income here is 9,332, which means our taxes will be what? What will the taxes be if our total income? In fact, we can even say our AGI right here, 9,332. What is our taxable income? It's going to be nothing because we have $30,000 of standard deductions and itemization or exemptions. It's a beautiful thing to behold. And then we just go down to his last year at 90 years old. He's got more from scheduled capital gains, qualified dividends, and taxable interest, and now 85,000 of Social Security, of which 13,000 is taxable. So he had his taxable Social Security plus his other stuff. 16,438 is the AGI right here at line 37. But he's got $35,000 of deductions and exemptions. Again, no taxes due whatsoever. So if you want to see a thing of beauty, my friends, you just that's what I wanted. You just go right. You just go right here. That, my friends, is a thing of beauty. Start taking advantage of the tax code. No increase in Medicare premiums before he had increase in Medicare premiums. No increase in Social Security taxation before he had 85% of Social Security was taxable. None here. No increase in tax brackets. No increase in tax on qualified dividends. No increases in taxes on long-term capital gains. And in this case, no increase in taxes or any taxes whatsoever on taxable interest, simply because he has no taxable income. That's a beautiful thing. Can he retire? The answer is fundamentally yes, without question. Watch. Just look at this, man. So now we're taking $2,750 a month for income. An initial thought was $2,250, 70% probability of success. He's going to die with $2 million. By all means, Scott Single, get the heck out of Dodge. People say, but what about this? What about, all right, let's go into the stress test and then we'll get out of here. What about this? What about that? So here's a stress test. If Social Security is reduced by 20%, his probability of retirement is going to drop. His success probability would drop to 50%. Is that enough to stop it? No, because we don't know what's going to happen with Social Security, and even that again assumes that his income goes up and up and up each and every year until he hits 95 years old. I just don't believe that's going to happen. Taxes go up by 60%. That's going to reduce it a little bit from 70 to 61. Social Security reduces it from 70 to 50%. 1% increase in inflation. We can make this higher. 3.5% increase in inflation. Reduce it probably quite a bit here. Yeah, to 17.3. I don't pay a whole lot of mind to that, though, frankly. And the reason is because if you have a big inflation increase, you're also going to have a big cost of living adjustment for Social Security. So a couple of things to be concerned with. No, the taxes don't bother me in the least because you're not going to pay any. And the taxes expense being higher by 60%, that won't happen. It's just not going to happen for quite some time. They're not going to start raising taxes on middle and lower income people anytime soon. That's a fact. Politicians won't get elected for that. So the tax I don't worry about. I do worry about a little bit of inflation and Social Security being declining. That is a point of consideration that you got to weigh. But for him, it wouldn't impede his ability to retire at 60, not in the least. As long as he does a Roth 401k, his $10,000, paid a little bit more today. And then when he does hang up his boots, slowly move $15,000 a year from his traditional 401k to his Roth IRA, pay the tax on the front end, take Social Security either at 67 or 70, whatever he wants to do. It won't change that much. But if you pay the tax on the front end, you will never pay tax again. It's just a wonderful place to be. So I hope you like what you see here. If this is you, Scott Single, good luck to you, man. You know what to do now. You got your marching orders, so don't forget to subscribe, my friend. Scott Single, make sure you subscribe and tell all your friends too. And comments, questions, thoughts, thumbs up, always welcome. Don't forget to go to the blog at heritagewealthplanning.com, and we'll see you next time. Thanks, guys.